Hello, YouTube. We're just waiting a second for Jules to get her shit together.
Getting it together right now. Okay. Almost ready. Oh my god.
Your nails look good. Did you just get your nails done?
Yeah,
They look really good.
Yeah, well,
I miss my long nails.
I got a fill.
Uh-huh.
The fill was $104. So pedicure.
Holy shit.
Thank you, COVID, for that.
Thank you, COVID. Yeah, but it was done in a highly protective, secure environment. So I'm glad you survived.
Okay. Yeah,
God, I can't wait to go home and get all snuggly cozy in bed. I'm really tired. Yeah, my Fashion Nova purchases brought me a lot of joy. Like this thing has like this bottom, it's a sweater's bottom, and I almost wore that, but I thought, it's purely wearing pajamas to work, but yeah.
Is this Fashion Nova too? I got my box yesterday.
So exciting.
Okay.
All right, so we're queuing it up. Get ready to go live of my live on Instagram.
Yeah.
Hi, Instagram. Hi, everyone. My name is Teresa Timms. I'm president of TDR Mortgage and Real Estate Group in Upland, California. Welcome to Tea Time with T. That's me. You can find me on the web at the SoCalLoanPro.com. This is our weekly series. Jules, take it away.
Okay, so today, you guys, we are going to talk about, like we said on Tuesday, Schedule E, so rental income, if you don't know what Schedule E income is, and corporate income and how you can qualify if you have those incomes, because those can be kind of complicated, a little bit more.
Yes. As loan officers, when we get a file and they have a bunch of corporations, instantly we're like, ugh. It's very labor intensive, especially if those people have come to us from other institutions. Just getting this cord to plug this in. A lot of times we get borrowers, complicated self-employed borrowers that have been with their bank or credit union and they've been declined. So,
losing your microphone.
Oh yeah, I got to plug my microphone in. Jeez. Get it together, T. Get it together. Thanks for reminding me because the sound quality is much better. Okay. Right. Check, baby. Check. 1 2 1 2. Check, baby. Okay.
Alrighty. So let's get started. First question. How are these two types of income, meaning Schedule E and corporate income, different from W-2 income?
Well, W-2 income is income derived when you're just a regular wage earner. You work for somebody, right? You work for someone. When you receive corporate income, it's because you own a business, either all or part. And corporate income is different. Schedule E income is rental income. And that's different because that has to be averaged over 2 years. And W-2 income is a one line item thing. It's just an income calculation. You know, W-2 income is very normal and regular. Corporate income is oftentimes not. You know, it's the whim of the business. How good is the business doing? How is the business owner managing their finances, their payables, receivables, things like that. So that's the difference between W-2 income and corporate income.
Okay.
And rental income.
Question number 2. And if you guys have any questions, even if they're not 100%
ask away.
related, if they're income related at all, just ask away. How old does your corporation have to be in order to claim that corporation?
Well, that's a great damn question, Jules, because everybody knows that in order to claim business income, that business has to have been around for a minimum 2 years. So that's a hard, fast requirement. You know, income is subject to a lot of, what's the word for it? Income, I don't want to say you can manipulate, but you can structure income different ways. And guidelines, often you can work around or outside a guideline. And there are some hard, fast rules in calculating corporate income. And in order to use income from a corporation, that corporation has to be in existence. It has to have been around for 2 years. And we know that off of the filings and things that whatever state they set that corporation up with, they go to that state, send us the information and they'll have to prove that it's been for 2 years if we suspect that it has not.
So what if you only own half of a corporation? How does that make the situation different?
Well, corporate income, a lot of times my corporation, I own that 100%, but I could have other partners. And the way that works is if a corporation is owned by 2 individuals, then the income is simply split. It's sometimes owned by 4 individuals, then it's quartered. So depending on your ownership interest in the corporation, any income or losses from that corporation will be added or deducted depending on the percentage of ownership.
Okay, question 4. We're going through them fast today.
Yeah, let's do it. Let's go fast.
Yeah. Can somebody qualify with just their corporate income?
Yes, but it's unusual that somebody do qualify with their corporation, because as a officer of a corporation, it's usual and customary that the owner W-2 themselves in some form or fashion. So oftentimes we see, sometimes people W-2 themselves $500, $1,000 a month just to have some, just to show that they're paying the officer of the corporation. Now, a lot of times people that are newer at corporations may not know all the ins and outs. And so it's possible that somebody may not have W-2 themselves for 1 year or 2 years. So it just depends. It's not 100% hard rule like the 2 years in existence. So yeah. Did that answer your question?
Yeah, that answered it. Clyde's actually in here.
Clyde?
Put a thumbs up. Okay, question number 6. We kind of went over this, but what is Schedule E income?
Schedule E income. So in the description where we have this posted, Schedule E income, like I wrote it out, so it's a really nice, concise statement, but really Schedule E income is just rental income. If you own properties, you declare the income, the rents received, and then you write off all of your expenses, and then you have something called depreciation that gets added back in, and then you have a bottom line figure.
Okay, so what are some misconceptions about Schedule E income?
I oftentimes see people that have Schedule E income think, well, I have a rental contract for $3,000, so that's my income. But the fact is, if $3,000 is your income, and that's what you declare on your Schedule E. I have a sample right here, and you declare that on your taxes. For example, this particular person, where am I at here? I'll do this one. So he has $19,000 of rental income, but then when you go to the very bottom, I think it's right here, his income, he's actually showing $10,000 positive. So when you look at all of his write-offs, so he had the $19,000, but then he wrote off nearly $9,000. So we go off of the bottom line in calculating this income. And then one of the things that's really cool, and believe it or not, a lot of loan officers and a lot of bigger companies don't know to add back in the depreciation expense. And sometimes, like on this one, where's it at? Where's my depreciation? Okay. So on this one right here, there's $3,000 of depreciation. So if his bottom line was $10,000, I'm going to add back in that $3,000 depreciation. And then note that these calculations are averaged over 2 years. So I just don't give you the income off of the 19. We also look at what happened in 18. Did you have a lot of expenses in 18? I recently had a situation where my borrower, if I averaged both years off of the Schedule E, they did not qualify. And this is where a skilled technician can get in and assist someone by qualifying, by just knowing how to present income to the underwriter. So we were able to show that in 18, they had $30,000 of write-offs that were not regular maintenance. Their property was vandalized, like severely vandalized. It was kind of like a one-off type of improvement. And we were able to do a letter, submit that to the underwriter, and we were able to get more rental income to assist them to qualify. And that was a loan that got declined by Chase, and we were able to turn it around, Maria. And we're actually getting docs on that file Friday. So I'm really, really excited about that.
One of my friends just joined us, Mateen. So hi, Mateen.
Hi, Mateen.
He's smart, so it doesn't surprise
He's a
me.
smarty
Yeah,
pants.
he's a smarty pants.
We love smarty pants.
We do.
We like dummies too. So we're all equal opportunity. We like all of our audiences. I feel like if you're somebody who's just kind of like simple, I feel like simple people are usually the happiest people because their minds are more simple. Yeah, they don't let all that stuff get in there and mess up their brain. And
Sometimes
so,
I wish I was stupid.
yeah, me too. Okay, so I'm just going to so those are just some questions that we had, some questions that past people had asked us. So we kind of wanted to start off with the questions. If our audience has anything they'd like to ask, please feel free and do so. So we talked about going back. So a corporation is just an entity, right? It's a business that somebody owns. Now, what if they own multiple corporations? So we have a situation right now where a gentleman applied for a home loan and he had 5 corporations. And I do stuff, whether it's hard, low loan amounts, low credit. I feel like not every loan is going to be easy. And I just, if I can help somebody, I want to help somebody. So we had to go over all 5 of those corporations, figure out which ones were in existence for 2 years, find out which ones were actually still active, and then which ones were W-2ing our borrower, because if you're receiving W-2 income from your corporation, that also has to last for a couple of years. Sometimes though, when on an S Corp, let's say you give yourself a combination of W-2 and K-1 income, if that has been occurring over a couple of years and it's consistent, sometimes I can get away with averaging that, if it makes sense. Sometimes people get busy, or maybe they're running a little bit thin with their bottom line and they can't really afford to W-2 themselves, because when you W-2 yourself, you're paying taxes and you're paying a lot of things. So a lot of small businesses especially, I see small business owners do this quite regularly, where they don't always do things like normal. And so in loans, if it makes sense, I can usually go against the norm of the guideline if I can otherwise put it together and make it make sense. And one of the things right now, like somebody that's a Schedule E, we don't really consider that person self-employed, because you can have a Schedule E. Anybody can own rental property. W-2 wage earners, people that don't have jobs, anybody can own rental property. But corporations are these business entities, and you file taxes every year with each one of your entities. And there are COVID overlays for people that own corporations or people that are self-employed filing a Schedule C. And those overlays are, well, we've always needed a profit and loss, but now we need to see 2 months bank statements to show that, hey, last year you made $100,000 in your corp, and that's what you claimed, right? You're showing that 100,000. Maybe you made 300,000, but your income was actually 100,000, and then divided by 12 is X amount of months. So then we want to see 2 months bank statements showing that you have deposits that equal what you made, that equal what your profit and loss is showing. So if your P&L is showing $10,000 a month, and we see $2,000 going into the bank, we have a problem. Your corporation isn't actively earning income. Therefore, we're not going to be able to qualify you, as if we wouldn't be able to qualify you like we would in the olden days. which is just pre-COVID, which I guess is not really olden days. So it just gets really tricky, and sometimes people, maybe they're making that income. Not everybody puts their money in their corporate account. Sometimes they get the money in the account and then they put it somewhere else. And smaller companies do this a lot. So it can get really tricky. So on all self-employed borrowers, we need a year-to-date P&L and 2 months bank statement showing that company is alive. Declining corporate income is a problem. Declining income, period, especially during COVID. So when we're dealing with somebody that has declining income, let's say 18, it was 150, 19, it was 100, and year to date, maybe they're on track for to show 80 or 90,000. So they had a pretty significant decline in 2019, and 2019 sets the tone for 2020. So a very detailed analysis would have to be put into play why that person has such a significant amount of declining income. So there's so many little nuances with corporations. Maybe that person, maybe it wasn't really like a decline in income. Maybe they made a capital investment in their corporation. So that's where the loan officer has to go deeper with the client. The loan officer has to go deeper into the file. And it's our job really to find solutions, to get in there. Let me show you this form. So the way we figure out corporate income is it's called the SAM method, Schedule Analysis Method. So this is a form that's on one of our mortgage insurance sites through Genworth. And this 3 or 4 page document, basically what we do is line one, recurring interest income. So it's just a form where it tells us we're on the corporate paperwork to find that, and we just plug in all the numbers. And basically this form does the analysis for us. But sometimes, like I said, it's not always black and white. Now, if your person easily qualifies with the money that, what your bottom line figure is on here, then it's really no big deal. But if your person doesn't qualify, then the loan officer needs to get in there and not take no for an answer, and find out a way that we could turn that loan around.
And Teresa is really good at that.
Yeah. Okay. So that's the corporate income. On real estate rental income, if it doesn't matter what you're renting the house for, like if you're renting the house for $5,000 and a month, and so you have $60,000 of income on your Schedule C, but you have $30,000 of expenses, we can't give you that full $5,000. So it goes off of the actual rents minus expenses, add back in depreciation, averaged over 2 years. And there are some small nuances to that. Again, if you find yourself that your borrower is not qualifying, what kind of analysis can we do? What kind of repairs did they make? What lender are we submitting it to? What program is it? So there's a lot of little, tricky things that happen in that space. But I think that's it that's all the questions I don't have questions. That's all the information I have for everybody today.
Yeah, no, I just want to touch on when people call in, like when she was talking about the small nuances, when people call in, they're like, well, can't you just quote me a rate? Like just on the phone, like
Yeah.
just initial conversation. That's why, because every case is so unique and so individualized that people are calling, well, just give me a rate. Just give me an estimate. I'm like, we don't even have like your middle name yet, let alone all of your documents.
I cannot help you.
So, rates are low, but it's so individualized and it's so unique that, like Teresa was talking about, especially with that kind of income, it's complicated. So, yeah.
Thank you, Jules. All right. Well, my name is Teresa Timms, president of TDR Mortgage and Real Estate Group. And you can find me on the web at tdrmortgage.com. log on, fill out one of our forms to get started and either purchase or refinance with us. I think I'm really hitting everybody hard to get in by the end of the year. I'm depending on what happens with the election. I mean, it's not over, but I have some kind of gut feelings that next year is not going to be so kind to the mortgage industry and so kind to the consumer. I think that rates are still going to be okay, but I think that there's going to be some regulations. There's been a lot of talk about the forbearances. Forbearances are going to be done soon. And what about the people that really can't pay? They were forbearing, they never got their job back. And so there is going to be a time when that comes into play where people aren't going back to work. And not everybody has a ton of equity. The only thing is different about this time and last time. Most people do have equity. So I think a lot of people that find themselves in a shitty situation like that, if they're sitting on $100,000 of equity, chances are they're probably going to take their money and run. Hey, let's solve this problem by selling the house. So I kind of think there's going to be some more inventory come on the market, but I'm just a little gun shy about what next year has in store for us.
Yeah, we're going to be, this year COVID hit us hard. Next year, the consequences of what we've been doing during COVID, I think, are going to hit us really hard.
It's a nice observation. I agree with that.
Yeah, well, I'm just regurgitating what you said into different words.
Oh, look who it is. Who's this? Clyde Hagan. Clyde, Raylene, that's right, girl. Not a lot of LOs know how to show rental income. And then Clyde says, I know how to calculate it. It's due on the 1st. And if you pay on the 2nd, you're late. Let's see what else is really insane. Great info on the bank statements. I had the same situation with the client. Yeah, that bank statement thing is so freaking tricky. Anyway. All right. Well, I'm done. My work here is done. You all have a beautiful weekend. Relax, rest up before Thanksgiving. I love Thanksgiving.
Just made a comment.
How do you know they're really important?
Because she's sitting right there.
Oh, okay.
So Joss is in the background. If you guys heard her talking.
What did she say?
Well, no, she was just talking to a client in Spanish.
Oh.
Because we do that too.
Yeah.
Yeah.
All right. Thanks, Jules.
Alrighty.
Thanks, guys.
Bye, guys.
Mwah.